Hi, I'm Tracey Ryniec, Zacks Senior Stock Strategist, and also the editor of the Insider Trader and Value Investor portfolios and newsletters at Zacks.com. And this week, I wanted to talk about gold and gold stocks. Should you own them? What ones do you buy? Do you just stick with the ETFs? Do you buy the physical metal? Do you buy the miners? Or is this trade even relevant today, or is it over? So I wanted to take a look at some of the miners to start off with and what kind of path I've taken with the value investor portfolio when I've been trying to get gold exposure. So I wanted to start off with just some well-known names. And the first one is Newmont, but I wanted to look at the actual stock charts on some of these stocks because these are the big ones. Newmont, the largest gold mining company in the world. And then you can see down here, I put the GLD, which is the physical gold ETF, as many of you know. And then Agnico Eagle is one of the most popular gold miners, big cap gold miners. So AEM down here, I put that on this chart. And then there's Newmont. And then I put one of the junior gold miners in because that's another angle and way you can play the rise in gold prices is with the juniors. ARIS is the ticker for Aris Mining. They actually just recently changed the ticker. So if you see Aris Water and some other errant articles about water underneath this ticker, that's because they just claimed it as their own. So it's going to take a little time to get some new content underneath this ticker. And most people aren't even following this ticker now that it's been changed. That's how much of a junior miner it is. But I thought it was interesting to see the 1-year charts on all of these to see where you would stand if you had bought any of these in the last year and what, if anything, are they moving together and what this kind of tells us about the gold trade this year in 2026. So people like the junior gold miners because historically they have had bigger moves on a gold rally. And that is what we're seeing here with Aris Mining. It's a relatively new gold miner. It's only been around a couple of years. It's headquartered in Canada, but it mines in South America. So it's a bunch of experienced gold mining executives who started this company. They have 2 working mines in Colombia and several others under development or exploration, we should say. They're not yet, getting anything out of the ground anywhere else, but their producing mines are quite active, we should say, and they're expanding the second mine, which should increase production from that mine in later this year by the 4th quarter of 2026. That's the timeline that the company just recently gave us on their recent earnings. But most investors care about the price of underlying gold. Are they getting out of the ground? And with the junior miners, that can be more suspect. So you get a lot more risk. You may get more reward with the juniors. You might even get acquired by one of the major big gold miners. But so that is a little more iffy, especially when owning the individual gold miners and not just the ETFs. So there are several gold mining ETFs you could own. One of the big winners over all the years has been the GDX, which is the large cap gold miners are all in that ETF. And then the juniors can be found in GDXJ as in junior. And that one has been around a long time too. I've invested in it over the years, starting way, way back, even during the financial crisis. these junior gold ETF have been around, but it's harder to find the actual juniors now. Many of them have been acquired, and it's been a rough go. It still exists, that ETF, but it is more difficult. And for that reason, many, if not all of these gold mining ETFs own silver mining as well. But silver, that's been hot as well. So if you want to own both, it's not a bad idea to own the GDX or the GDXJ. In fact, I'm just going to put on GDX onto this chart so we can kind of see where that one stands in comparison to everything else. Not a surprise, it's moving with the large cap stocks because Newmont and Agnico make up a big percentage of the GDX. So it is highly concentrated in these few big caps like Barrick and Newmont. I think Newmont used to be over 10% of this ETF. So again, it does spread the risk a bit, though. You're not just owning Newmont, you're getting a basket of these large caps, but still very solid performance, as you can see. But RS, the junior, your patience has been paid off. But look at the decline in a lot of these miners in the last month. So let's look at it on the charts, because this is a real buying opportunity in some of these miners. If you believe that gold is still in this bull market and is going to rally even higher than where it's been, it has been hanging out over 5,000 an ounce for the last several weeks. This is going to be another record quarter for earnings and free cash flow for most of the mining companies, because it's going to average close to 5,000 probably for this quarter. We're not quite at the end of this quarter yet. And now gold, because of the Iran war, has actually declined here and has been briefly back under 5,000. So that's still, near the all-time highs, which did reach a little over 5,500, but only briefly. It's mostly been hanging out at between 5,000 and 5,300 the last couple of weeks. But now it's dipping below that 5,000, and that's causing some weakness in the gold mining stocks, as you might imagine. They're going up when gold is surging. They're going to come down when gold weakens a bit. And so we're seeing that here. And in these kinds of cases, it's weakening even more than what the overall gold price is doing. So over the last month, gold is still up 1.8%. But you can see Newmont now down 10, almost 11% on this latest move. So this is a real buying opportunity in something like a Newmont. If you felt like you missed this rally over the last year and you've been waiting for some kind of entry point, this is getting you in much cheaper on some of these, like a Newmont. You can see Agnico not so weak, and people are not abandoning ship or taking their gains in Agnico, but it has been executing maybe the best out of the largest of the miners. You can see Barrick I just put in, and that's down 9.2 over the last month. So they're hanging in on Agnico. There are some true believers over there on that miner. But some of these others, you can see really pulling back. Interestingly, Eris is not that weak, other than it has come off of a little bit off of its earnings here. But since we've gotten that, it's kind of just been hanging out. But it is off of its more recent highs before the earnings at the beginning of March, way up here when it was hitting all-time highs. So I'm still liking all of these stocks. I only own Eris in the value investor, but we have two other miners in the value investor as well. One is a large cap. Other one is, I guess I would call it a mid cap. It's not super small, but it's not big. Mid cap miner, has Canadian mines, and then Eris that we just kind of took a chance on because it does have producing mines. And as long as the geopolitical situation in Colombia remains fairly stable, then they're able to execute. That's what this is all about, able to get it out of the ground. Then you're going to see some pretty good numbers and free cash flow out of them. Newmont doing a big share buyback. It is paying down some debt. It has a base dividend. They didn't do a special dividend or change what they're doing with their shareholders. But as they buy down those shares with this massive share buyback, it does mean the yield is rising slightly because the number of shares is on the decline, but it's not much, a couple cents, but we'll take it. We'll take every cent they want to give us. One of the disappointments with Newmont this last quarter, even though they had records across the board, is that they did raise their CapEx. So we are going to see that with some of these companies. They aren't going to give it all back. They're not going to give it all in share buybacks and dividends or just pay down the debt, because all miners are going to have some form of debt. It's very expensive to build out those mines and to get that gold or silver or copper, whatever the metal is, out of the ground. And so that is going to cost them money. So they will take this time in a rally and a bull market to use some of that free cash flow to, put better footing underneath the business. But it's very encouraging that Newmont has paid down so much debt already. And so their balance sheet is looking a lot better. So just looking at some of these numbers, what does it look like on valuations? Because when I bought these stocks for the value investor, and it was mostly about a year ago, it was, they were all dirt cheap, but gold still hadn't retaken even $4,000 an ounce yet. And so the earnings were on the rise, but not as much as what we're seeing now. And the analysts have had to catch up with the price of gold because this rally has been so steep. So looking at Newmont, it's got a Zacks #1 rank. It's got an A for the VGM, but mostly because A for momentum and growth. It says it's a C for value, but the PE has come down as these shares are falling about 10 or 11% here. We're still in value territory with all of this. PE of 12.5. PEG ratio is still attractive because we do have this strong earnings growth. 27.6% expected, as you can see, for 2026, and another 17.6 for 27. But no one knows 27. That's all going to be predicated on what happens with gold. Many of the gold analysts have price targets of 5,500 to, I've seen as high as 6,000, or even one or two at around 6,500. So it's a mix, and we'll see. But anything over 5,000 is just very strong earnings for these miners. Again, as long as they're getting it out of the ground, and it's going to be great for their balance sheets. But we will see this pullback, as we do with all commodity stocks, that rise when the commodity is on fire and come back down when they think that this rally is over. I don't think we're near the end of this rally yet, but I know some of you are wondering, why is gold weakening during the Iran war when there's all this uncertainty and the possibility of another inflationary spike? Well, right now, gold is moving opposite of what oil is doing. So as oil has been spiking, gold has been pulling back, and vice versa. So I don't expect a big decline. I have always thought, even without the Iran war, that we would see it come back down to about 4,500 before the rally resumed. So this is all healthy. Things were getting a little bit too hot earlier this year. It's good to have a cool off. And again, this gives us an opportunity to buy some of these big mining stocks at better valuations. So it's just scrolling down. We already talked about the PE and the PEG. Price to book at 3.5, price to sales at 5.2, but that's always going to be a little bit higher on the price to sales. And we should see this PE begin to rise as long as, the earnings aren't, and if the stock continues this rally. But we are in this kind of good spot here to get some of these miners. Newmont is an easy one if you're looking for just a big cap play, because it's the largest and it does have this better balance sheet now and good cash flow management. It still is shareholder friendly with the dividend. Let's see what it's yielding now on this pullback. Almost 1% you're getting on the dividend, but it isn't the highest paying dividend out of the big caps. Let's take a look at Agnico, the popular gold miner that's holding up. So we're still not really getting much of a pullback on Agnico Eagle here, but it too is a number one ranked stock. As you can see, it's got a similar dividend, almost 0.9% there. You can see it is pulling back off those highs, but not as sharply as Newmont. Forward P is a little more stretched, but is this stretch 15.6 times? Not if we're seeing these earnings growth of 60%. And then you can see 2027, almost nothing, because that's way too far in the future to really know what's going on. And maybe production growth is expected to slow. That's the other thing that everybody's looking for in the mines is, are you able to find more gold or buy it somehow? And are you able to get more of it out of the ground so you can cash in when these prices are high? Because again, this is the highest we've seen, even inflation adjusted, higher than the 1970s here. So these mining companies know not to pass up these kind of market conditions. They usually last more than 1 year. So that's why I am still a big buyer in these gold miners, and I do like to buy on any kind of pullback. So Agnico, let's see what else is happening with some of its other valuations. Price to sales is more expensive here at 8.7, price to book at 4.2. So this one has never been the cheapest out of the large gold miners. And I don't expect it to be, because you are paying up for the better execution. Also, keep in mind where the mines are located, because geopolitical events, as we've seen over the last couple of weeks with Iran, are a real thing. And so if you can find a gold miner that is mining in more stable, like geopolitical countries, then maybe you'll have a little bit better luck. But these are all the factors when you're buying the miners, and that's why people do just like to look at and buy the ETFs, the GDX and the GDXJ. But let's take a look at Eris again, because this is the junior gold miner that I own in the Value Investor. And you can see market cap of just 3.8. So it is a lot smaller. It did miss, but Zacks.com does not have many analysts covering it, just has this one. So if they get it wrong, then they do. They did have the estimate of 58 cents. Someone tried to tell me on StockTwits that this was Canadian, and that's why they got it wrong, but it wasn't. It was just this one analyst was a little too bullish here, and then they reported just the 46 cents. They did beat on the estimate, I think, on other sites, but that had more analysts covering it. But it's hard to find analysts on these smaller gold or silver miners. So keep that in mind. We're lucky we just have the one, because this is a fairly new miner. But you can see the big gains here this year, $2.68, but that's really down from 60 days ago when they were just a little too bullish about what might be happening. Although Eris did increase its production for this year if they get that second mine with this expansion really kicking in the fourth quarter. So anything can happen between now and then, but so far Eris has been executing well on its plans. So that's all part of it too, is management telegraphing what's happening. And I hope if they can't make that Q4 deadline that they've set for themselves on this bigger production, that they let us all know earlier rather than later, and not wait until the fourth quarter to let us know. So we'll see on that. But look at next year. 2027, because they do assume that that bigger production will be in place in that second mine. And then that's when you're really going to see it step up, even if the price of gold declines there, because production will pick up the slack on the other end. But if we keep these high gold prices, then that's where you're really going to see these big earnings growth. So we have 109 expected for this year, 52 for next year, but this is the lure of the junior gold miners. It's all fun when you're expanding and you are executing, and not so much if things go wrong. You do have little room for error if you only have one or two mines that you're relying on, and Newmont or Agnico have many mines. So even if they do have an execution issue at one of their mines, they at least do have some diversity and can fall back on the others. So that's one of the good things and one of the reasons people like to invest in these larger gold miners. So that's just three of the gold miners. Let's look at valuations on Eris. It has this really cheap PE because of the surge in the earnings. Let's see what else. Price to sales is a little bit lower at 4.1. Price to book is also a little lower at 2.6. But this is one, again, where things can get, a little bit crazy. I do like this value scorecard because it does give some others in the industry, and you can scroll over and kind of see what's happening. These other gold miners have higher Zacks rank. Eris just has the 3 right now, but it's not as heavily covered. And then the analysts got too bullish, so they've had a cut to adjust on the full year. So that's why we got the 3. But what is the industry looking like for gold overall? We've gotten most of the earnings in now. I would say 99% of the earnings are in on all the gold miners. And you can see we knew it was going to be a great quarter with those record high gold prices in Q4. Remember, this was Q4 they just reported, and that's before $5,000 gold. And you can see we've got the ones across the board. So it's not hard to pick out something based on the Zacks rank here, and then a couple of 2s. So you're either really crushing it or you're not. Do we have anybody that's even down there? We do have a couple of 4s. So this is interesting. It could be they haven't reported yet. Let's look at Harmony real quick. That's one of the bigger gold miners. They have had some execution issues, so that's why they've had a struggle with the Zacks rank. Let's look and see. So they do have the big growth expected for this year, but it could be that analysts were expecting something a lot better. And now, we don't even have any analysts. We have one for the fiscal year, which we're on, and they have lowered. So even though Harmony is one of the larger gold miners, they're not a junior, I don't believe. Let me see. No, 9.6 billion. But it's just not heavily covered. It's been in a bear market for many years. And if you are an up and coming analyst on Wall Street, energy and gold and silver isn't necessarily where you want to be. Another area is the banks. Who wants to cover those when nobody's paying any attention? But you can have the field all to yourself, as we're seeing. But you can see this really big drop in Harmony on the Iran war here. So this stock is looking more attractive as well. So I'm not putting too much into that number 4 rank here because we only have the one analyst on Zacks.com covering it. There are probably more if you look around on some other platforms that have some coverage. So I would be interested to see what they say. But we still do have the earnings growth expected for this year. Again, it's all execution, and you have to kind of dig in to what these miners are saying and look for ones that are paying a dividend. It looks like they are, with a yield of almost 1%, and which are doing share buybacks. And what are they doing with all this cash? That's key to where the stock may go. So there's some good oil stock or gold stocks out there right now. Again, I am a big believer in them. If we got even a bigger pullback, say 20% or bigger, then I am kind of diving in with maybe even looking at some silver stocks on a bigger pullback, because silver tends to run with gold as well, as we've seen. So yeah, I'm still liking gold. And usually when these commodity bulls start, they all kind of run together. Copper, precious metals, oil, and that's what we saw in the 1970s. We also saw that in the Great Recession era when all of them had big bull markets, and now we're back in one. And so poke around, look at some of these individual holdings. If you can't stomach some of the risk with owning the individuals, then no harm in owning one of the ETFs. There's numerous, but the oldest are the GDX and the GDXJ for the juniors, and then you will ride out some of the volatility. But if you want just the gold, there's numerous gold ETFs as well. You won't get a dividend with that, but you don't really have to worry about execution either. So there's a lot of ways to play gold right now, and these are only some of them. And as always, we aim to bring you some new ideas in investing here every week. So be sure to tune in to see what we'll bring next. And I'll be back in a couple of weeks with some more stocks.